Hello, my friends. Today is April 15th. My name is Joseph, and this is Markets Weekly. Today, we're going to talk about three things. First, we'll talk about inflation. Second, we'll talk about the Fed's efforts in fighting the market's implied pricing. And lastly, we'll talk about what's happening with the big banks. Now, first, starting with CPI. As we all know, inflation is the most important macro variable right now, because that's what the Fed is thinking about. If inflation surprises to the upside, then the Fed is going to keep rates higher for longer and maybe keep hiking, and that's not good for asset prices. In the same way, if inflation is surprising to the downside, that suggests that maybe rate cuts are around the corner, since the Fed is almost completing its mission in slaying inflation. So this past week, we had some new data on that front. We had a CPI print, and CPI looks like headline 0.1% month over month. The market saw that and it rallied tremendously, because 0.1% CPI on a monthly basis is basically around 2% annually. It would suggest that inflation is over. But if you look in the details, though, it tells a very different story. If you look at core CPI, you'll see that, in fact, inflation has shown itself to be very persistent. So core CPI is CPI without the more volatile components like food and energy prices. And as we know, over the past few months, energy prices have been drifting lower. So when we take a look at core CPI, so CPI that's basically focused on more structural inflation, you can see that over here it's around 0.4%, and it has been around 0.4% for the past few months. On an annualized basis, that's annual inflation a little bit less than 5%, which of course is far above the Fed's target of 2%. So even though headline inflation is trending lower because of changes in volatile prices like food and energy, core inflation, which is what the Fed has been focusing on and which is much better predictor of future inflation, is very sticky. One of the key drivers of core inflation is high labor costs. So labor is a major input into everything in the economy, and especially in the US, since the US is largely a services-driven economy. Now, we also had new data on wage growth. The Atlanta Fed Tracker is one of the best sources of data for wages, and you can see here that it's been around 6% for the past few months, but it looks like it ticked up a little bit in March from 6.1% to 6.4%. So definitely wages don't seem to be skyrocketing in the same way they were, let's say in 2020 and 2021, but they seem to be stuck at a persistently high level. Wage growth at 6% is simply not compatible with inflation at 2%. If everyone is getting a 6% raise every year, that means they have a lot more money to spend on goods and services. That means that inflation can continue because people can continue to afford higher prices. And that's why the Fed has been emphasizing so heavily that they want to see the labor market, quote unquote, come into balance. That is to say, unemployment rise a little bit. And it seems to be moving there a little bit, but it's not quite there, and it's going to be a slow process. Now, let's again go back to the biggest puzzle in markets right now, and what is going to be most important in understanding how all asset prices unfold in the coming months. And that is the disconnect that I'm showing here between the Fed's dot plot rate projections and the market's implied path of Fed policy. The Fed again is telling everyone that they're going to try to stay higher for longer. They want to keep rates at around 5% for the rest of the year and maybe take them down a little bit next year. The market is saying that, the Fed is going to start to cut rates significantly just in a few months. And that is part of the reason why the equity markets are buoyant, rates are lower, and the dollar is selling off. The data we see in inflation, as we just described, really doesn't support that narrative. And we see a full onslaught of Fed speakers this past week coming out and trying to guide the markets away from all those rate cuts and closer towards the Fed's own stance. Now, this past week, the speakers that we had are speakers that are actually more important. We had Governor Waller, voting member, President Austin Gillespie of Chicago, voting this year, and we also had John Williams speak in a Yahoo interview, and he's also a voting member. And those guys, they basically all said the same thing, that the Fed is not contemplating rate cuts right now. But there is a little bit of a divergence between some of the Fed speakers. The debate within the Fed really isn't about rate cuts. The debate in the Fed right now is about whether or not we should keep hiking rates. There are people in the Fed who think that we got to go maybe one more hike, and maybe that might not even be enough. And you have other people in the Fed, such as Gillespie, who will tell you that we just want to pause here and take a look because we have all this other turmoil happening in the banking sector. We want to see how that shakes out before proceeding. Now, that's actually totally reasonable, as it would be reasonable to hike an extra 25 basis points just to be sure. Honestly, it's not that big of a difference. The biggest chasm really is not within the Fed, but between the Fed and the broader markets, because no one here is talking about rate cuts. Now, here I'm showing a speech by Governor Waller, who is he's a governor, so he's a voting member, and word has it that he's becoming more influential in the FOMC with the departure of Lil Brainerd. And his line in the speech is saying that, okay, let me read it. Another implication from my outlook and the slow progress lately, and he's talking about inflation, pointing again to the sticky core inflation measures. As of now, monetary policy will need to remain tight for a substantial period of time and longer than markets anticipate. So this is really strong language from a Fed governor telling you that the markets have it totally wrong and we are really going to be staying higher for longer. Again, he's thinking that we'll hike one more time and then we'll maybe just hold it there for a while. Not everyone is on board for hiking one more time, but as far as all the Fed speakers are concerned, everyone is on board with holding it around this level for the rest of the year. Okay, so that's Governor Waller. Let's take a listen to Austin Gillespie. So the Fed speakers, they see the market pricing and they know what they want to do. And so they're all trying to come up with explanations as to why the market is pricing so many cuts when the Fed themselves have been so clear. If you ask Fed President John Williams of New York, he'll say that it's because the markets are very optimistic in pricing in how quickly inflation will come down. And he's saying that the markets think inflation is going to come down very quickly, so the Fed will have to cut rates later on because soon it'll be mission accomplished. That's his take. Now, Austin Gillespie has a different take. Now, his take is that the market is pricing in rate cuts because it thinks that the Fed is not able to hike anymore and needs to cut because of financial stability reasons. Now, let me read from his speech. He says, there's a branch of the financial dominance school of thought that takes the argument even further. They argue that if there's a chance of significant financial stress, we should preemptively cut rates to reduce the odds of it. Now, he's thinking that the market is pricing in rate cuts because the market thinks that, well, the Fed is going to blow something up, just like Silicon Valley Bank, from aggressively hiking rates. And that fear of financial stress is going to force the Fed to cut rates. Now, Austin Gillespie takes this in a different direction than John Williams, but he also has an answer for it. And he's saying that, later on, if there is some threat of financial instability, the answer is definitely not rate cuts. The answer is regulation. The answer is for the Fed to do more targeted, Fed and other regulators to do more targeted measures to make the financial system more resilient rather than do these broad-based tools like rate cuts. Again, he's saying that he's trying to explain why there's so many rate cuts. He thinks that it's because the market is afraid of instability, and he's saying that, this is the wrong response. This is the wrong tool to potential instability. The tools are the things that we have and we're doing right now. more regulation, and special targeted facilities like the special bank lending facility there. So we'll have more Fed speakers in the coming weeks, but so far they've all been pretty uniform in saying that pushing back against market pricing. And if they persist, and if they're right, that then those rate cuts will have to come out of the market, and we could see, I'd say, the dollar strengthen, rates go higher, and equities decline. Now, one of the factors that actually is causing all these rate cuts to be priced in is that there's concern by some market participants of what's happening in the banking sector. A story is that there's instability in the banking sector, and one, that there could be more banks that are in trouble, and two, even if there are no more banks that are in trouble, maybe this is going to cut down on bank credit creation and thus slow down the economy and in a sense help the Fed complete its job. Now let's look at the most recent data on credit creation to have a sense on whether or not that's working. So every week the Fed publishes aggregate data on what's happening with the commercial banks. And you can see in March there seems to be some turmoil. Now it looks like a steep decline, but part of that is simply that some of the banks were basically liquidated and put into receivership with the FDIC, so they were removed from the data set. So that could be misleading. But what I want to highlight is that the most recent data shows that banks have begun making loans again. Things are becoming back to normal. And as we noted last week, it really does look like the bank panic is over. So things are resuming. But we can get even better color on what's happening in the banking sector by simply listening to what the banks are saying. This past week, we had two really big U.S. banks report, JP Morgan, Wells Fargo, Citi as well, but I'm going to focus on JP Morgan and Wells Fargo. And there'll be more banks reporting in the coming weeks. So here's a quote from JP Morgan's earnings call this past week. And it says, touching quickly on the health of U.S. consumers and small businesses based on our data, both continue to show resilience and remain on the path to normalization as expected. But we continue to monitor their activity closely. Spend remains solid, and we have not observed any notable pullback throughout the quarter. So this is the biggest bank in America, who has a wide range of businesses, wide range of branches all throughout the country. And they're telling you they don't really see much of a difference. Now, not every bank is going to have the same story. Now, we're a big country. We have about 4,000 banks, a few thousand credit unions, and some of them are going to be, in some distress. But, JP Morgan has a lot of data, and they're everywhere. And they're telling you, and this is a really important sample, to keep in mind that things are okay. Now, let's move on to Wells Fargo, which is also a very big bank that has branches everywhere. Now, Wells Fargo is giving a similar message to JP Morgan. First, things are normalizing, and what that means is that things were super elevated and accelerated the past few quarters, but now they're getting back to the normal growth that we're seeing. And so they would point towards debit and credit card transactions. Here we can see that although it's coming, the level is decreasing on a quarter-on-quarter basis, slowly normalizing, but on a year-over-year basis, they're looking at transaction volumes up around 10%. So from their perspective, things seem to be okay as well. There's definitely not a strong sense of despair. Many people also noted that there must be tremendous amounts of deposit flight out of these smaller banks into these too big to fail GSIBs. Wells Fargo said that, yeah, we had some deposits come in, but then they all left. So again, signs of normalization. And JP Morgan noted that they had a sizable amount come in, but they're not really sure if they'll stay. They're thinking that these deposits, they're hot money, people come and people go, and they might be leaving later. Overall, they're all saying that deposits are going to shrink, and obviously they're going to shrink. Why? Because the Fed is conducting QT, a few $100 billion of QT a year, and that's going to shrink deposits. That's what QT does. But anyway, that's all I had to cover today. And going forward, we're going to be monitoring more closely what other banks are saying to see just how big an impact the bank panic had on their activity. And if the impact is not that large, which is what I expect, then I think rate hikes are back on the table, and we would see that reflected in additional Fed speak going forward. Okay, so that's all for today. I'll talk to you guys next week.